welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make you a little bit of money here. My job is not just to entertain, but I'm trying to teach a little education. Call me 1-800-743-CBC. Tweet me at Jim Cramer. We have three economies right now. Not one, not two, but three. Two of those are booming, although one shouldn't be. And the third one is hurting badly. And it needs help right now. Of course, when you look at the averages, with the Dow dipping 1.2 points today, the S&P gaining 0.58%, the Nasdaq jumping 1.12%, you can't see it because all three groups are mixed together. That's why tonight I'm going to break them down for you. The first and the most exciting is everything connected to artificial intelligence in the data center. We are constantly being told that this is a bubble, an accident waiting to happen. Ever since the launch of ChatGPT in late 2022, the data center's build-out's been responsible for 75% of the S&P 500 returns, 80% of its earnings growth, 90% of capital spending growth. Thank you, Michael Semblus, chairman of market and investment strategy for J.P. Morgan Asset and Wealth Management, for calculating those for us. The bears want to throw freezing cold water on the whole AI complex, which is why they constantly compare it to the end of the dot-com era. I hate that analogy. The heavy hitters in this business think Meta, Alphabet, Amazon, Dell, Micron, AMD, Microsoft, Broadcom, Oracle, and, of course, NVIDIA all have incredibly deep pockets. OpenAI is a little more opaque, but they've had no trouble raising money. Oracle might be overspending on data centers. I would argue it definitely is. But worst case, they can sell some stock and offer a whole lot of corporate bonds. And remember, they have a tremendous track record. All of these companies have been criticized for spending on AI like drunken sailors. There's a cottage industry of bears who spent the last couple of years urging you to short these stocks, not just sell, but short them, especially the biggest short of all, NVIDIA. And they never stop. Even though they've been wrong every step of the way, I question how they stayed in business. I've been saying you either believe in the fourth industrial revolution, as described by NVIDIA CEO Jensen Huang, or you don't. The bears don't believe it. Could they be right? Of course. But I've been telling people to just buy NVIDIA since I named my dog after the company when the stock was just under $4, and now it's $189. So far, it's paid much more to be a believer. That goes double on a day like today when Micron rallied nearly 6%, Dell gained 9%, and AMD jumped over 11% on data center orders and accelerating growth rates. Those are like takeovers. As for the comparison with the dot-com collapse, most of the companies that went under back then had no earnings and little revenue. And a lot of them were dishonest. Their stocks traded on page views. Nearly everyone involved with the AI data center story makes real money. There's no real basis for comparison. I know that because I ran money in the year 2000. My hedge fund finished the year up 36%. Why? Because we shorted everything in sight. We knew that these companies were going lower. So I can tell you the AI stocks look nothing like those. I know one when I see one. Those had no earnings, very little sales, and bad balance sheets. The second economy. That's the so-called real economy, which is kind of not so hot. We lack economic data because of federal furloughs, but the reliable Carlyle Group just put out a survey showing that hiring's really slowed down. We know from street research that freight has just gotten softer, a great indicator of the future. FedEx caught a downgrade. Housing has slowed as mortgage applications have gotten weak, even as interest rates have come down. Retail sales are not great, especially if they're related to housing, and much are. Industrial numbers are slowing. Autos seem like they're about to roll over, along with used cars. Travel and leisure finally seems to be slowing. Now, of course, there are pockets of strength in the real economy. Banks are still lending and have surprisingly solid credit numbers. Small and medium-sized businesses are doing well, another surprise. But all sorts of big companies are struggling. Even the once safe consumer packaged goods stocks that seem to dominate the new low list. More on that later. Then there's a third economy. It's the speculative economy. This actually looks like the end of the dot-com era. And I do hope that this economy runs out of steam before it drags down the entire market. The bears love to invoke the year 2000 to condemn the AI stocks. But like I explained earlier, the AI stocks have very little in common with the hundreds of dot-coms that got wiped out back then. Instead, it's the speculative stocks that remind me of the dot-com era, a group of companies with no earnings to speak of that need to raise money to stay afloat. Now, we see these in nuclear power, or crypto, or quantum computing stocks. These have all been bid up furiously by retail investors. Stocks like Oklo or Rigetti Computing, I think they're too high. That's the fault of retail, though. I fear we're at the cusp of some gigantic equity offerings for some kinds of these companies. We got one on Monday from an also-ran quantum company called Quantum Computing, and another one today from Joby Aviation, the flying car company. It offered 30.5 million shares of new stock at 16.85 per share. It closed up from the deal 17.37. But way down from the nearly $19 price of yesterday's close. That's brutal and very 2000-ish. These speculative companies will all need institutional money, but because their stocks roared on no real volume thanks to retail buyers, the big institutions won't want to touch them unless they're offered at big discounts. And even then, don't count on them to hang on to their stock for long. They'll be banging them out, making a buck here and a buck there. I think that this speculative part of the economy needs to run out of gas. It needs to burn off the froth. I wish the bears would just go after these names instead of constantly harking on NVIDIA or now AMD. I mean, come on. Sure, there's gold up on a spike of calamitous buying. I'm the wrong guy to say it's a red flag, though, as I've been a gold bug for decades, and to me, it's finally going to where it has to go. Scarcity of gold, abundance of federal debt, say it all. Stick around. We're going to hear from Agnico Eagle, my favorite gold miner, later in the show. Putting it all together, the first economy, AI, is the fourth industrial revolution. And while there might be periodic overbuilds, previous industrial revolutions tended to burn out only when there was too much debt layered on. That's what happened to the railroads in the 19th century. People started laying track everywhere using borrowed money. Most of these companies went under. That's when you need to start worrying. But the hyperscalers, except for Oracle, have so much cash, there's nothing to be concerned about at this point. The second economy, the real economy, needs multiple rate cuts, definitely, to save it. Because employment may be running on empty for all we know. The third economy, other than Palantir, which actually has earnings but is incredibly overvalued, although I think it could still go higher, this speculative cohort has to be stopped before its froth overwhelms everything else. I want the bears to direct their wrath and ire on these stocks, not the companies with great balance sheets and very long-term records of tracks of success that seem to be ignored entirely. Here's the bottom line. If these speculative stocks that are the real bubbles, not the AI plays, yet you never know, if you listen to the bears, they conflate them all. As I say in How to Make Money in Any Market, these people aren't there to help you anyway. So please, stop taking them so darn seriously. Let's go to Josh in Vermont, please. Josh.
Hey, Jim. I just wanted to start off by thanking you for giving me the confidence to divest from my mutual fund holdings.
Well, thank you. Thank you. Now, remember, I do think that 50% of your money should be put in index funds and only 50% stocks. I am a little more conservative than that, but I want you to take control of your money. Absolutely.
Great. Yeah. No, it's definitely turned it into a much higher performing portfolio.
Excellent. That's great, but let's not be greedy. Go ahead. How can I help?
Yep. So with the recent pullback in Sportradar, I was looking to start a position. Do you think the rise in prediction markets is a threat to the fundamentals, or is it a good time to buy?
No, I don't. I think that the fundamentals are good here. I do think that there's a general belief that I get now when I go out talking about my book that people feel that there's too much gambling. And that does have me worried because that's an existential threat. I don't think they can do much to it, but I'm hearing that chatter way too often. Thank you for the kind words. It's the speculative stocks that are the bubbles in this market, please, not the AI plays. But you wouldn't know if you listen to the bears. They want to take down the big guys, so they're leaving the small stuff that's going up way too much in retail buying alone. They're not helping us at all. Mad Money tonight, CoreWeave has bounced back in a big way over the past month on the heels of a flurry of great AI deals. And I'm checking in with the company CEO to see if there's more room to run. Then, with all the bubble talk going on, the best thing we can do is check in on the charts. And gold has been on a tear in recent weeks. I'm sitting down with the top brass at Agnico Eagle Mines to see how the company stands to benefit from the rally to record highs. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
over the past few weeks, we've heard about a bunch of new AI infrastructure deals, and it's taken practically every stock in the group, including CoreWeave, which builds data centers and then basically rents out their computing power. You know, we've liked this from the day they did their IPO. CoreWeave alone has scored a $6.5 billion expansion of its business with OpenAI, the second one in the past few months. Their total contract value with OpenAI now weighs in at $22.4 billion. And on top of that, they just announced more than $14 billion with a contract with Meta Platforms. Clearly, Wall Street's been underestimating the demand for computing power and for the work of CoreWeave. Just today, CoreWeave announced some new tools to help programmers develop AI agents, and the stock jumped almost 9% in response. It's now up over 65% from its lows last month, and it's up 250% from where it came public in March. So can it keep running? Let's check in with Michael Intrator. He's the co-founder, chairman, and CEO of CoreWeave to get a better sense of the story. Mr. Intrator, welcome back to Mad Money.
Thank you, Jim. It's great to be back.
Okay, so Michael, tell us what exactly are you providing that people keep selecting your company, because there's now a host of companies that claim they do the same thing you do.
Yeah, I guess we can take the approach that imitation is the highest form of flattery, right? Look, we have built the premier solution for delivering AI infrastructure to large consumers who need access to the infrastructure at scale. That's what CoreWeave has done. And we've done it everything from building the data centers, through building the infrastructure inside of the data centers, through the supercomputers, through the networking, all the way up through the software, and provide, what is the best solution in market for consumers of compute.
Okay, so when I think that the companies I'm seeing being bought by many of our viewers, but certainly people in the public, they're buying Nebius and Iren and TeraWulf. How do you distinguish yourself from what they're doing?
Yeah, look, there's a lot of people that are stepping into the space that are trying to build an infrastructure solution. But at the end of the day, we have spent years building out our software solution that provides best-in-class delivery of this infrastructure. It's why clients keep coming back to us again and again. It's we regularly will have clients that have consumed infrastructure on other platforms turn back to us and say, we tried it on other platforms. We're coming back to you because this is the best solution in market. It has to do with the software solutions, the integration of the software into the hardware. The traction that we get with clients once they get to the proof of concept stage is overwhelming. There's over a 90% win rate once they actually begin to use the infrastructure on our platform. And that's just astounding, right? And that really is a reflection of how much better this infrastructure works when it's consumed through the CoreWeave solution.
Oh, it's 90%. Means
90%.
You're pretty darn proprietary. I like that. We had Jensen Huang yesterday for our CNBC Investing Club. It was a great one-on-one. And one of the things that he talked about was he dismissed this notion of the circular deal. And instead, he talked about the notion of being a really great investor. And he mentioned the investment in CoreWeave. Now, how did that come about? Because it clearly was, at the time, risky. You and I talked about it. I wasn't worried about it because I knew that it was a real investment. It was not to be able to give you money and then you give him money.
Yeah, look, there's a narrative out there right now that has to deal with circular investment. And I think it's just fundamentally flawed, right? The reality of the situation is really large, really important technology companies across the space are buying infrastructure to deliver it to their clients. Meta, Microsoft, Amazon, Google. I mean, the largest tech companies in the world are purchasing this infrastructure because they have demand. There's nothing circular about that. It's a fundamental infrastructure build out that's taking place. And when you have such a massive scale investment in infrastructure, it is not unusual to see partnerships as people try to serve infrastructure to the consumers. It happens in other markets. It's happening in this market. I don't think it's circular at all. We've been tagged with circular investment since NVIDIA made its first investment of $100 million years ago. $100 million. We've raised $25 billion. They didn't invest $100 million for circular acceleration of their business. They invested $100 billion because they looked at the solution we provide and said, that's a solution that we want to own, that we want to buy into, that we want to own a piece of. And that's what it is. I think the, this narrative around the circular investment, it's of the day, but it will pass because the fundamental drivers in the market are enormous.
Okay, so yesterday, Jensen also said something that you told me. I almost said taught me, but I'll go with taught me. You know what? Which was that when you, what you're left with after the 5 years, whatever, is actually quite valuable because the actual platforms have tremendous ability for other customers, and they're going to be owned by you. And anyone who thinks that once you amortize it after 5 years, they're therefore going to be in big trouble because they own something, are dead. They're just dead wrong. Can you put it in your words? Because I think can really explain it well.
Yeah. So look, when we go into a deal, we buy. We get a client that comes to us and says, "I want to buy $2 worth of compute." We go out and we buy $1 worth of infrastructure and we deliver that to the client, right? At the end of the day, we're going to be left with the profits that we make during the contract term. Right. We are going to pay back the debt. We are going to support the interest, cover the OPEX. And at the end of that, we're left with what I refer to as the equity slug, right? It's the last piece of infrastructure that you then get to run in a fully depreciated manner for as long as it is able to generate revenue. And historically, we have seen this infrastructure last a lot longer than people expect. We have seen our clients come in and purchase this infrastructure looking to buy for 6 years, even with options into the 7th year. And at the end of the day, I always look towards the people that are putting up the money, that are buying the compute, to guide me in my understanding of what the expected value of the infrastructure will be over time. If they're willing to pay me for 6 or 7 years, that's how long it's going to last, at least. That's the minimum.
Yeah, well, it sounds to me that the equity portion is certainly worth holding for. Now, one other thing is that you've got a deal. It's going to be like 3 more weeks. You're buying a company called Core Scientific. I know there's some people who are not happy with the price, but at the same time, I believe the stock is up substantially from when you made the bid.
Yeah, we've been doing a lot of things. We've been buying companies. We have been building software organically, and so yesterday we announced the acquisition of Monolith. That's an incredible company. All of our industrial clients are trying to figure out how to bring AI to bear on their engineering processes, on physics, on the build out of their fundamental value proposition to the market. And by buying a company like Monolith and integrating that into our service, you get to make huge progress towards actually bringing AI to a portion of the market that hasn't yet fully incorporated it. Another acquisition was OpenPipes. We just released.
But how about the Core Science? I mean, maybe you're not allowed to talk about it, but to me, I'm trying to understand why someone wouldn't be happy with being up big.
So we're up 60% from when we made the bid, or they're up 60% from when they made the bid. We are extremely confident that this deal is going to go through. We're extremely excited that it goes through, and if it doesn't, they're going to be great partners for us no matter what, because they run some of the data centers that our infrastructure is in. We are going through the process that you have to go through. Some shareholders are excited about the deal. Some shareholders aren't as excited about the deal. In the end, we believe, our board believes, the management company of Core Scientific believes, the board of directors of Core Scientific believes that there is real value here for joining the two companies together. And we believe we will be successful.
Well, there it is. Let's leave it at that. Congratulations on all these big deals. I've been to where you, not one of your facilities, but a facility where you do work inside. And I know it is quite proprietary. People who think that it's just plug and play really don't understand. And I was taught that not by you, but by Jensen Huang. So anyway, I want to thank Michael Intrator, co-founder, chairman, and CEO of CoreWeave. Always good to have you on, Michael. Thank you so much.
Thank you so much.
Mad Money's back here for the break.
Coming up, are we in a true bull market? Or is there a bubble about to burst? Cramer's going off the charts and seeing if the market can keep up in the long term. Next.
Yesterday, the market pulled back hard after a strong opening. Today, the averages erased those losses and then some. But every time we go higher, we kept hearing endless growling from the bears and the billionaireistas, as I call them, in how to make money in any market. And they insist that the market's gotten frothy, the irrational exuberance out of control. And this entire rally will blow up in our faces. Just you wait. Or, as I used to say in Confessions of a Street Addict, get out now! So tonight I want to give you another perspective, rebuttal to the bears who insist that this bull market's headed directly to the slaughterhouse. That's why we're going off the charts with the help of Joe Fahmy. He's been right. This is a portfolio manager at Zora Capital LLC, and Joe is the founder of JoeFahmy.com Education. As Fahmy sees it, this market's still got significant upside. He's been in this business almost as long as I have, and in his experience, big moves can last much longer than most people tend to expect. Just when investors think something can't go any higher, it usually does. Same goes for declines in a bear market. Right now, we've got so many skeptics who are adamant that this great AI data center bull market must be at the end of its rope. But Fahmy thinks that they're underestimating how much upside remains here over the next 2 or 3 years. Most importantly, Fahmy doesn't think this moment looks anything like the end of the dot-com era that you keep hearing from all the rich people who come on our shows. Forget a bubble in AI. If anything, he says there's a bubble in people calling for bubbles. What makes him so confident? Okay, as Fahmy mentioned the last time we checked in when he was dead, right, in late June, if you want to use the dot-com analogy, then you actually need to know how the dot-com boom and bust cycle played out. And I've been saying this. I think a lot of the critics weren't there, didn't live it. I did. Let me show you something. This is a terrific chart. It shows the action in the NASDAQ composite from the launch of Netscape at the end of 1994. A lot of people thought that was the beginning, through the dot-com peak in March of 2000. Basically, the dot-com bull market lasted a little more than 5 years. At the same time, this chart also shows the performance of the NASDAQ since ChatGPT launched in November 2022. You know what? It's a very similar trajectory. But again, if you want to use the dot-com analogy, then using the Netscape comparison, which makes sense, we're still in the equivalent of 1997. And telling people to sell right now, right here, well, how do you think you did? What do you think? You say, hey, time to get out, get out now. Well, guess what, sucker? Now, Fahmy believes he remains bullish here because we keep seeing huge AI infrastructure deals and enormous capital expenditure announcements. The big hyperscalers haven't cut back on their spending at all, as I keep telling you, and I talk about this nightly. As Jensen Huang, the CEO of NVIDIA, put it, we're a couple $100 billion into a multi-trillion-dollar infrastructure build-out, end quote. In other words, he thinks we're not even 10% through this transformation. I think he knows more than the bears. How about the technicals? All right, take a look at this daily chart of the S&P 500. Fahmy points out that the 50-day moving average has held firm as a powerful tool of support ever since the post-Liberation Day lows in April, confirming that there's been strong institutional buying. During this period, there have been very few big down days on heavy volume. Each time the market has dipped, like the beginning of August or the beginning of September, the big institutions almost immediately stepped in to buy. Despite all the hand-wringing you hear on TV, the people who actually run money, well, they seem pretty darn happy with this market. Nice floor. Next chart, check out this daily chart of the ARK, A-R-K, Innovation ETF. That's Kathy Wood's basket, legendary, whatever you want to call her, but she likes these high volatility stocks. And this is a chart of her extreme volatility stuff with a heavy tilt toward technology. This growth ETF just completed what Fahmy considers a healthy period of consolidation from mid-July through early September. Basically, he thinks the growth stocks with big momentum had to digest their gains from their lows in April through the highs in July. Last month, that period of consolidation ended, and the ARK Innovation ETF caught fire. What about all the endless chatter about how the market's too frothy, too euphoric, full of irrational exuberance? Remember, I said a third of it actually is. Just look at the Goldman Sachs U.S. equity sentiment indicator right now. Fahmy points out that it's actually at below average levels. Sure doesn't look all that exuberant to me. That's pretty dispositive. Then there's the Deutsche Bank Consolidated Equity Positioning Index measuring global investors' net exposure to equities. Right now, the reading's above average. In terms of overall bullishness since 2010, we're at the 70th percentile, on the higher end, but certainly not at extreme levels. Makes sense to me. Every uptick in this market is met with disbelief. We've got a legion of skeptics telling us that this bull market is doomed. You hear them all day. As Fahmy points out, real bubbles don't get called out this loudly while they're happening. Remember, when Alan Greenspan warned of irrational exuberance, that was December of 1996. We still had more than 3 years left in the dot-com boom, and you made a legendary amount of money during that period. You don't need to get too worried about an AI bubble until the bears give up. And that definitely hasn't happened yet, has it? Fahmy has one last point. We're now in the fourth quarter, and historically the fourth quarter tends to be a strong one. From 1950 through 2024, the S&P's rallied on average 4.2%. That's pretty strong. And that's just the baseline. In years where the S&P has hit new highs in August, September, October, meaning like this one, it's rallied nearly 7%. I mean, these are just gigantic numbers in the fourth quarter, and it hasn't finished the fourth quarter in the red in a single time. Keep in mind, when we get to the fourth quarter, lots of money managers will eagerly buy up the market's biggest winners because they have to show their clients what they own at the end of the year. If they don't own the best performers, well, you know what? They do look like morons. And they get angry calls from their investors who want to know why the heck they put their money in their hedge fund when that hedge fund didn't buy NVIDIA. Here's the bottom line. The charts as interpreted by Joe Fahmy suggest that this market's got more room to run, maybe a lot more room to run. And all the complaints that you hear about irrational exuberance, well, it simply aren't borne out by the facts. When I look at his charts and I listen to what he has to say, I have to say I agree with him. Let's go to Charlie in Texas. Charlie.
Hello, Jim. First time, long time.
Excellent.
And I would like to thank you concerning the program you had last week about mutual funds and their financial objectives with the fund manager and the fund itself.
Yes.
To me, that was a real eye-opener.
Oh, thank you. You know, it's tough stuff, but I got to tell it as it is. You know me.
And, I tell you, that really helped me quite a bit. And the reason I'm calling is about 3 weeks ago, I bought a small position of Broadcom. And I was wondering, should I buy some now or should I wait for a while?
Well, I like Broadcom very much. I usually don't like to violate basis. You've already got a good position, I'm sure. But we own this one for Charitable Trust, and Jeff Marks and I go back and forth all the time about how great it is. And it's certainly included in my book, How to Make Money in Any Market. I would tell you this. It wouldn't hurt you to buy more. I think it's that good a situation. All right, the charts interpreted by Joe Fahmy suggest that there's no sign of any bubble or any bursting. If anything, maybe the market's got more room to run. I agree. Much more made by today, include my sit down with the top brass at Agnico Eagle Mines. The move higher in gold has shown no signs of stopping, and you know I'm a believer. So I got to check in with one of the leaders in the mining space to see what's next for the precious metal. Then, is it time to rethink the traditional safety trade as we know it? I'll give you my take on what is most beleaguered cohort and how it fits into today's market. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. What do we make of the spectacular rally in the price of gold, taking it above $4,000 an ounce for the first time in history? I always tell you to have some gold in your portfolio. Yes, I am a gold bug, as a kind of insurance against inflation or currency devaluation or just economic chaos. And this year, that insurance policy has paid off. Gold's up 54% for the year. But you know what? You've done much, much better if you own certain gold miners. Take Cramer Fave at Agnico Eagle Mines, up blistering 117% year to date. These guys have a bunch of low-cost mines coming online in the not-too-distant future. In other words, as long as gold prices stay high, I mean, these guys can make a killing. So let's take a closer look with Sean Boyd. He's the chairman of the board, former longtime CEO of Agnico Eagle Mines, and longtime guest of Mad Money. Mr. Boyd, welcome back to Mad Money.
Great to be here, Jim.
Sean, I have to first comment you on your the left side. You're of what I regard as some great decor in your office.
Yeah, the gold bull. I think you gave that to me when gold was around $1,000.
Well, and you and I both thought it should be much, much higher. Now that it's at $4,000, do you stay as are you as convinced still, like I am, that it could still go higher?
Yes, I think the trend's been in place for the last 20, 30 years. Gold's been under accumulation by central banks, and debts around the world aren't going down, and there's still inability or unwillingness to really make the tough choices to manage debt. So this is a perfect environment for gold. When we have certainty in the world, and stability, paper's king. But when you have uncertainty and instability and disorder, gold is king, and that's where we are.
Well,
now.
you also taught me over the multiple years you've been on the show that it's not like we're finding a whole lot of supply. It's become very hard to find gold.
I think that's interesting. So we're getting a lot of questions from investors that are sort of new to the space. They're saying, yes, but at these prices, aren't we going to see a massive wave of incoming mine supply? And we're just not. This is still a challenging business from the perspective of finding high quality deposits and to get them built in a reasonable amount of time. I know, having been in this industry for 40 years, that the cost to build a new mine are still high. Permitting timelines are longer. So even at $4,000 or $5,000, there's not a massive wave of new mine supply coming on stream. There's just not.
And you have suggested to me over and over again that model, which says you can go all over the world and find gold, has not panned out. There have been governments that have turned on established gold miners versus Agnico Eagle, which you said, listen, here's the way we're going to do it. We care about safety. We care about sovereignty. We care about the rule of law. How's that working now?
Yeah, that strategy's been in place for decades. And the strategy for us is to follow the geology, look for those good rocks, but only go into those parts of the world where we could see a multi-decade sort of runway to build a high quality business. And it's really sticking to that strategy, because it was well matched to our skills and well matched to the opportunity set, has really paid off. And I would suggest that as we get into a higher gold price environment, the attractiveness for governments in more difficult countries to expropriate or want more of an ownership interest in their gold mines, that only goes up.
Now, let's talk about a natural demand. World Gold Council estimates that gold jewelry demand still represents the largest source of annual demand for gold at roughly 50%. Is that stable even at these prices?
I would suggest yes, but the real driver here is really central bank demand. And I think the trend here has always been there. It's just people are more aware of it now. If we roll it back a few years when we were first chatting, I think just before 2010, in 2010, roughly, the Chinese decided for the first time that they were going to open up their markets for the importation of gold. So they've been playing the long game here with gold, like they have with critical metals. And so as we've seen central banks start to buy it, that's the pillar, and that's the basket that's sort of underneath the market here. And now we've got these issues with debt. We've got the underlying potential of more inflation. All of these things are really sort of building on top of that underlying demand, which has been coming from central banks and from jewelry, and now more from the investment side.
What do you think about the ratio and relationship between crypto and gold these days?
Well, I think when we talked a few years back with crypto, when it was around $20,000, there was talk then that crypto was really going to become the new gold, and gold was going to become irrelevant. That hasn't happened. No. Here we are, record high stock prices, record high gold prices, record high crypto. I think crypto and gold can exist together. And I think what's really exciting about gold is really this digitization. It's going to create new markets for gold. It's going to create new demand for gold. And really what digitization for gold is something the World Gold Council has been working on, is to actually make gold more liquid and make it more financially easier to access. And I think that's going to open up new markets for it. So that's an exciting additional source of future demand.
Well, look, I buy my gold through Costco, and they so rarely have it. It's just a great trade. I know that your CEO totally agrees with me on this. How come they can't just stock it? How come Costco runs out of it every day?
Yeah, that's a tough one. And I think that goes to the underlying issue about having gold being available in the market. And we've seen that for years. And so up here in Costco, what Costco's selling is a 1 ounce gold maple leaf. And that maple leaf contains 100% of the gold in that coin comes from our Detour Lake mine. So this is a way to sort of make those coins more attractive. But we'd love to see more gold in retail hands. And I think that's certainly what China wanted, not just for the government to own more gold, they wanted their citizens to own more gold. And I think that's a way that we should be moving in the West as well.
Do you think, like I do, that all gold is doing is really catching up to where it should have been all along?
Yes, and I've lived this for 40 years, and I've seen gold at 250. So this has been a steady climb up. And if we actually look at gold's performance since 2000 to the end of September of this year, gold's up a total of 1,400%. The annualized CAGR is almost 11%. So it's done well, but it's done well very quietly, and people are just sort of catching on now, and I think that's a good thing.
Do you think that, I know when the president's talking to the head of Canada, I think, oh my God, are they going to somehow tariff Canadian gold in a way that makes it so that we should be in American gold? Not that we have to worry about that with you, but do you think those discussions are happening?
No, gold's actually Canada's second largest export. So we're a big producer, but I don't think we're going to see tariff on gold. Gold is money now. Right. I don't see that. I think, though, but the gold industry, it's kind of interesting because the focus is on critical metals, and gold, they say, is not a critical metal. But without the gold business and the technical skill set and the relationships that gold miners have around the world, we wouldn't be able in the West to build a critical metals business without that foundation that the gold industry's been working and building for many, many decades. So the gold industry's in a good position. It's still hard. We're still dealing with nature as an industry, but the good thing is costs seem to be under control. So all that margin is really going to the bottom line. And if we look at the current spot price, it's about $750 higher than what the average realized price was in the second quarter of this year. Wow. So all that goes to the bottom line. So you're going to see tremendous growth in the industry's EBITDA.
Well, Sean, I want to thank you, as always, for your insight. It's incredibly valuable. I hope our viewers listen. I know I sure did. That's Sean Boyd. He's the chairman of Agnico Eagle Mines, AEM, the best there is. Thank you, Sean.
Thank you, Jim.
Everybody's back in. Right.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the way round. Time for after all. You say this song. Tell you about my buy, sell, just good. And of course, half questions at a time. My step first, the graphics look fly. You play the sound. And then the lightning round is over. Are you ready, Ski? That's on the lightning round. Let's start with Bill in Oregon. Bill.
Hi, Jim. Thanks for taking my call. And thanks for keeping the average investor involved in the market.
Well, that's what I want.
I've been an investor for 55 years, always individual stocks. And I have two lists, ones that I own, the stocks I own, and the second list is stocks that I previously owned or monitoring.
Okay.
And I was looking over the second list, and I'm noticing one of the major companies that I have on the second list has really crashed out. And I look further and see they're losing money. And I believe years ago you had these company officials on your show.
Okay.
The name of the
which
company is International Flavor and Fragrance.
Oh, IFF. Okay, the problem there is that it's just flatlining. The sales have flatlined. There's really nothing that I can say that's good about it. It has no growth, and that's disappointing. It used to be a better company. Let's go to Dennis in Florida. Dennis.
Booyah, Jim.
Booyah.
How you doing, brother?
I'm having a good day. How about you?
Yeah, great day, brother. Love the market.
All right.
Long-time admirer, brother, and I appreciate you taking my call.
Thank you.
I got to say, go Pack, go. I just got to throw it in there from Wisconsin.
All right, sure, understood.
So it's as hot down here as it is in the markets, and God bless Cramerica and President Trump. My question for you today, Jim, is do I buy or sell New Fortress Energy, NXE?
NXE's about a really, really big move. Why don't you do this? Why don't you no doubt probably have your the cost basis is well below this. Take out your cost basis tomorrow, and you can let it run. Let's go to Bryce in California. Bryce.
Hey, Jim. Booyah. I grew up in the living room with my dad watching you as a kid, so thank you.
Yeah, you're quite welcome.
Yeah, my question is about SoundHound. I'm up over 50% in the last few months. It's a leader in AI agentic agents, and they're merging voice and vocal AI.
Yeah, you see, SoundHound is a company that got, what happens is it got NVIDIA's endorsement, and ever since then it's been on fire. I say this. I say it's up a great deal. It's not making money. I would take a little bit off tomorrow and then let the rest run. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, out with the old, Cramer's breaking down how to find new growth opportunities in this market and where you should position for the long term. Next.
We got to rethink the idea of safety stocks. That's a major theme of how to make money in any market. It's a controversial one because my conclusion is very unorthodox. I realize the only true safety lies not in the stocks of companies that make stuff you buy no matter what the economy does, but in stocks of solid growth companies. This is chock full of them. The traditional safety stocks, like the consumer packaged goods place, are deadly these days. But the superior growth stocks, that's what comes back after the big sell-offs. That's what works. The market didn't used to operate this way, but times have changed. If you scrutinize the new low list, what do you see? It's all the old safety stocks. What's down a lot? How about Kimberly-Clark down 2% today, nearly 9% for the year? How about Clorox down 26% for the year? Campbell's, that old story, down 27%. Kraft Heinz off 18%. McCormick, it didn't look like a terrible quarter when the Spice Company reported the other day, but the stock was slaughtered anyway. PepsiCo reports tomorrow. It's got a 4% yield, a powerful activist firm trying to get that stock back in the plus column, but it's still down more than 8% for the year. Then again, that's a lot better than ConAgra, down on nearly 33%. Ouch. So there's no safety in these stocks. Same goes for many of the pharmaceutical companies. Take a look at my old fave, Bristol Myers, a now poorly performing investing club holding that's almost a permanent resident on the 52-week low list. It should pay rent for its basement digs. But you could say that about many of the drug stocks. Safety first, how about safety last? On the other hand, the tremendous growth stocks are hanging in there like champions. This is a complete inversion of how things were when I first started out in the business. Yep, when I got into the business of professional money management at Goldman Sachs, the Japanese were ascendant. This was the early 80s. They were buying everything that moved. But the Chinese, they were trying to obliterate our companies by selling knockoffs and wiping out whole industries like they did to the people like my father who worked in the big gift wrap mills. They just couldn't compete. So what did we do? Well, we pushed the stocks of Heinz and Kimberly-Clark and Bristol Myers Squibb. We knew that they were never going to have a Chinese bottle of ketchup on the table. We were right. Everything's changed now, though. These companies used to have the world as their oyster. Now they've run out of new places to sell. They're being hit by inflation, by tariffs, by Costco, which knocks them off with superior private label products. But growth stocks, these are stocks that don't need the Fed to cut. They don't need to worry about inflation. They're not hostage to anything except their own innovation, and they're not under any sort of real attack from overseas. That's what allows their stocks to bounce back so fast. When we coined the term FANG about 12 years ago in this show, we did it with the assumption that you could own these stocks through thick and thin. We've had a recession since then, COVID, Liberation Day, and so many other vicious stocks, sell-offs. Yet almost every time they've come back. Their performance far, far exceeds the S&P 500. But the food and drug stocks? There's a phrase when you're using heavy machinery. Safety never takes a vacation. Here's what I say. The only safety out there is growth, because these days, the traditional safety stocks, they always seem to be on vacation. I'd like to say, as always, the bull market summary. I promise I've got it just for you right here on Mad Money. I'm Jim Cramer. I'll see you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.